I'm laughing because my wealth of knowledge won't fill the full hour, but that's okay. Our presentation this morning, or this afternoon I guess it is called Keep It Simple, and I left the S off and you can fill it in the way you want. You know, when Jennifer and I were preparing for this, we were sitting in a room, we were kind of debating, you know, how to present information around SR&ED credits and digital media tax credits and some of the tax credits that are available to early stage and late stage technology companies, as well as some thoughts around business structure and, you know, some of the legal areas that we see from time to time. And we debated doing a skit. I still think it would be a good idea, but Jennifer ruled me out. But in any event, what we've tried to do is combine a couple of themes or thoughts around business and starting your own business. We were thinking about what you might be thinking about as you're going through your VeloCity program and through the engineering program and possibly thinking about starting a business. So we've looked at it from that perspective. So we're going to cover a few extra topics than what our original presentation was all around. My name is Paul Hendrikse. I'm a partner in the Waterloo practice of PricewaterhouseCoopers. I've been there for a while. And for my career, I've been helping early stage and late stage technology companies with financial reporting and other aspects of their business. So a lot of what's in our presentation today is what I have learned through what I call the School of Hard Knocks, having watched my clients or others go through some of the issues that you guys might be thinking about early on in a business's life. And Jennifer's going to help me on the more technical stuff that I've seemed to have forgotten a little bit about. I'll let her introduce herself.
I'm Jennifer Psutka. I'm a senior manager at the firm. I've been there for about 10 years, and like Paul, I've worked with a lot of different technology companies, from small startups that are pre-revenue up to some successful public technology companies that have commercialized and are kind of on their way. I also have worked quite a lot in the nonprofit sector, which I find has been also very rewarding. So I'm here with Paul. I'm going to talk a little bit about tax credits and things, and thanks for having us.
Oh. So we entitled our presentation Keep It Simple, and with the S that you can fill in the blank around. And this is just a quick quote: everything should be made as simple as possible, not one bit simpler. And that's really a key lesson that we've experienced as we've been watching and helping our early stage companies. There's lots of opportunity to make this complicated. The business world is complicated, legal information is complicated. And what tends to happen is you kind of start thinking about your business and how you might want to get it set up and all that stuff. And I've often seen people want to create very complicated structures. And what inevitably happens is the first time any outsider comes in to do something to help you out, maybe it's a customer, maybe it's a financier, maybe it's somebody else, they look at it and they just kind of, oh, why is this so complicated? I don't understand this. I'm not used to that. I need something very simple. And some of that complex stuff that you may have set up, they ask you to take it out. And since usually in those situations the other party's in the driver's seat, you end up doing it. So it's sort of setting it up in the first place is a bit of a waste of money. So like I said, we're gonna cover off and talk a little bit about a couple of extra topics. And what we try to do is we're going to try and put this within the context of being in your shoes, having, you know, maybe nearly or partially completed an engineering degree and have some ideas around what it might be like to start a business or to commercialize that technology. We've sort of skipped over the part where you have to deal with the technology officer, whatever it's called here at Waterloo, to get the technology to yours. So we're just going to start the story where you've got an idea, you've left the university, and the intellectual property that you've developed here is sort of your own. So where do you start? And the starting point really should be the development of your business plan, which is really a document that you're going to create to articulate your business strategy. The business plan needs to define your business objectives. What are you trying to do with your business? Are you trying to, you know, how are you going to attack your markets? Which markets are you going to go through? What are your customers? What problem are you solving? There's a whole ton of information that you'd want to put in your business plan to help you really develop your goals and to develop which direction you're going in. And you know, a lot of times I talk to people and they're like, oh yeah, business plan, blah, you know, everybody writes it to it's 4 or 5 pages or maybe 50, and it gets drafted. It's kind of done half-heartedly. almost as if it's to check off a box in a checklist of things to do before you get started. And I think that's a really big mistake. And it really does come back to what it's like to start a technology company. 9 times out of 10, you've got a new technology and you're going to try and bring that technology into a new market. You're going to develop a market, or you're generally not outplacing somebody. And even if you are, you really need to understand who you're outplacing. Why is it that your product or service is going to be better or different such that you can outplace them? And it's in sort of sitting down and really doing your business plan in a organized and sort of really serious fashion that you can start to think about some of the issues that you're going to encounter and some of those markets that you're going to have to deal with, or some of the questions that you're going to have to deal with. And I've got sort of the 3 bullet points on the bottom there. Be realistic, focus on solutions to customers' problems, and be action-oriented are 3 sort of really subtle points, but they're often missed, especially the be realistic one. I've read a lot of business plans where the markets invariably are at least $100 million or more. And when asked, how did you come to that number? There's not a really good answer. So, is that realistic? I doubt it. Very few markets are that big, or else they haven't been defined well enough. Focus on customer solution. This is another one that I see all the time. And this is, really have to think through the entire business plan, because a lot of times, and perhaps you've heard the expression about you've built a better mousetrap. Have you guys heard that expression? Where most people, yeah, good, okay. The problem is, if nobody's buying mousetraps, it doesn't matter whether yours is good or not. It doesn't matter whether yours is better than the competition or not. Nobody's buying mousetraps. So, you're not going to be successful. So you really have to think about what problem is it of your customers or your potential customers that you're trying to solve. And if you can really narrow that down and articulate it well, then you've got a really good business plan, because it's going to be focused on a particular market, a particular customer, and allow you to go to that market or to that customer with a solution to one of their problems. And they're going to be that much more likely to want to participate in your product and service and hopefully acquire it. And of course, be action-oriented. And that really does come back to, it's your business plan. It's not just a document that you're going to draft up on day 1 and throw it in the closet and forget about it. It really should be this living document that directs you in terms of what actions and what steps you're going to take. How are you going to achieve some of the goals that you've set for yourself? So, once you've sort of gotten through that and you've got an idea of where you're going to go, you've articulated your business strategy, you've developed some action steps that are going to address the development or the further development of your product, that are going to address how you're going to attack your marketplace, which customers you might go after and how you might go after them. You might want to start thinking about, before we start doing that, we actually have to create an organization and think about some of the more legal aspects of the business world. And so, once you've sort of got all that ready, there's really two key legal structures that you can consider as a business. The first is a sole proprietorship or a partnership, which is another way of saying an unincorporated entity, and the second is an incorporated entity, a limited liability type company. Have you guys take much business before you get into engineering? So do you know what those kind of concepts are? I don't need to go through them. Sort of seeing a general nod of the head. So I won't then really go through them. What I will go through, though, is some of the key trade-offs, because sometimes we forget about that. And we're going to talk a little bit more about taxes and SR&ED and digital media tax credits. But by and large, those tax credits are available to incorporated businesses rather than unincorporated businesses. And they can be substantial, especially if you're doing a significant amount of research and development, or if you're developing something in the digital media space. So again, if you've done your business plan and you kind of know what actions you're going to undertake, and you know where you're going to start spending some money, you can start thinking about whether it makes sense to spend the money to incorporate right off the bat, because you'll know whether you're going to qualify, or at least potentially qualify, for some of those tax credits. If you're going to do more selling activity, there's not a whole lot of tax credits that relate solely to going out and selling your product. And so maybe if that's what your business, first or next steps are going to be, maybe it's worthwhile holding off the incorporation of your business until you perhaps need to go back and reinvest in research and development, those kinds of things. Because, and sort of, from hopefully what you can tell from my remarks is an incorporated company, it tends to cost more. There are costs around incorporation. There's costs around continued compliance with respect to income taxes and having to file multiple returns that are different than and cost more than the unincorporated business that you might want to otherwise set up. So, assuming that you've got a great business plan, you've decided how to incorporate your business or how to at least structure your business between those two, you've assessed those impacts and thought about what makes sense for your organization. The most likely next question is, I need some money. Now, I don't know about you guys, but I'm not independently wealthy, so I couldn't finance any of my harebrained ideas if I wanted to. So I'd have to go and find some people to help me out. And again, this is something to think about when you're doing that business plan. I kind of skipped over it. I'm going to come back to it here. Is if your business plan suggests that you're going to need financing, you might just automatically default to some sort of incorporated business. It is far too difficult in any unincorporated business to bring in other investors, whether or not those are your friends and family, your own credit line, or angels, and the list kind of goes on. And you know, I purposefully put the list in this order for good reason, because this might be, and other than perhaps, yeah, and I debated whether you'd switch angels and government around, but this is probably the right order in terms of where you seek your financing. And so up there, it's you and your own credit line, and that's got to be your starting point. It's got to be your starting point for two reasons. The first is it's going to be readily, it's there, it exists, it's your own resources that you've already accumulated somehow, some way. The one thing that I'd encourage everybody starting off a business to do is, before you get started, decide how much of your own capital you're going to put in. Put a number in on an envelope, put the envelope away, remember that it exists, and kind of keep that in the back of your mind. The other thing I do is I get another envelope, and I put another number on it, and that number is how much will I sell this business for at various points. Put that one away. And then as you go through the execution of your business strategy, keep those in the back of your mind, kind of refer back to them when events happen, but set those limits. It's kind of like, I'm going to call it a little bit like gambling, but it's the same concept. And we've all seen the advertisements on TV about knowing your limit and playing within it. That's the same idea. I mean, you are starting off an early stage venture. They are high risk. The likelihood of success may be low. So you don't want to necessarily overextend yourself too far, because you personally have to pay all that money back to somebody. Your friends and family line is your friends and family are your next source of financing. And the reason that they really are your next source of financing is hopefully your friends and family like you. Hopefully they believe in you, and hopefully they'll be willing, a little bit more so than anybody else that doesn't know you, to support your idea. And again, they may be able to move your business along for a little bit through the acquisition of shares, or maybe they want to just give you a loan and see how that goes. But your friends and family, you sort of do have to go around and tap them on the shoulder and see if they're interested to support your business. Both your investment and the investment that you can generate through your friends and family are really important stepping stones to the next one, which are the angel investors. So angel investors differ from, and I'm going to skip all the way down to venture capitalists, in that venture capitalists are firms that are a little bit more organized. Angel investors are independently wealthy folks, perhaps people that have done it before and have sold their businesses. And I probably can imagine we can all think about 8 names at least off the top of our heads that have done that. One of them trying to acquire a hockey franchise instead of supporting early stage businesses, but hey, to each their own. But angel investors really do look to see what participation have you and your sort of friends and family around done in the business. If you haven't participated in investing in your business, they're not that likely to. And that's just logical, right? I mean, if you've only put $10 into your business and you're asking them to put in $100,000, they're kind of like, why should I? I mean, you've only got $10 in the game. So angel investors are sometimes difficult to find, though, because again, they're people like you and me, and they don't really put, I have money to loan, I have money to invest. They don't put signs out like that. But that's where connections to guys like Jennifer and I, accountants tend to know who these guys are, lawyers tend to know who these guys are, and other people in the community tend to know who these guys are and what they're investing in, and whether they have the capacity to support your business. So building a network is an important element around financing your business plan, because you want to be able to tap those shoulders and say, hey, do you know anybody that might be interested in this type of business or might be able to support me? The other cool thing about angel investors is, as I said, angel investors tend to be the people that have done this before. They tend to be, and especially in the tech space, they tend to be engineers that, 10, 5, 8, 7 years ago were sitting here and had an idea and did it. And so their predisposition tends to be around supporting other companies. In fact, most of the angel investors that I know of are all in that sort of classification. Of course, there's the government, and that really talks about some of the programs that Jennifer's going to cover. There is a host of funding programs supported by either the provincial government or the federal government, and the trick is really just spending some time to research which ones apply to you and which ones may not apply to you, and focus your efforts on those, of course, that do. They tend to cover specific things, especially around engineering and development of new technology or new content. I put on banking relationships, excuse me just for a second. I put on banking relationships. It's a bit of a crapshoot to try and ask your bank to finance you. You have no collateral. It's like going to ask for a mortgage without a house. They're probably not going to. That said, if you move your business along a little bit further than those first few months, and you are doing shred activities or shreddable activities, there are a number of banking institutions that will finance those shreds. So, and Jennifer's going to talk a little bit about the cycle as to how you end up converting those tax credits into cash. Some banks will finance the sort of intervening period or some part of the intervening period. So it may be worth it, but generally speaking, at that early stage, you might as well not go knocking on the bank's door. They're likely not going to do anything in terms of supporting your business outside of perhaps keeping your credit line alive. And then finally, there's the venture capitalists. And as I mentioned before, those are more organized groups of folks that are looking to invest in earlier stage companies. And much like, no, actually, let me start that over again. Yeah, it's not much like. Venture capitalist firms, I mean, they're all different. They all invest in different things. Some of them are, very much into digital media. Some of them are very much into software or internet technologies. Others are more into technologies related to mobile applications or communications devices or anything in that sort of telecommunications space. So one of the things that you want to do before you start talking to VCs is really understand who are they investing in, what types of technologies are they interested, where in the spectrum of investing are they? Are they early stage supporters or are they more late stage supporters in the business life cycle? All of those things will help you narrow down your focus to talk to the people that are more likely to fund your operation than the others. And as you go through any of these things, the one thing that we see all the time is, remember, it's better to own 10% of something or something that's worth something than 100% of something worth nothing, which is a mouthful, but we can all do the math. But one of the things that we see a lot is founders or entrepreneurs wanting to sort of hold out. They don't want to dilute themselves. They don't want to dilute themselves too far. They only want this much for this much money. And invariably, that sort of funding arrangement falls apart because there can't be a meeting of the minds. And what happens when you have that mindset, I mean, nobody's going to fund you. And as a consequence, you sort of burn through your credit line. You burn through the money that your friends and family gave you. You maybe found an angel investor, but they don't have an unlimited amount of resources. So you kind of burn through and you're done, and you haven't launched your business right. And so you end up, you didn't dilute yourself, so good for you, but your business kind of failed and you don't have anything to show for it. So it'd be much better off to manage that a little bit more. Maybe own 50% of something that is successful by going through and thinking about the right valuation. Oh, I keep hitting the wrong button. So I mentioned government as a source of funding, and these sources tend to be in SHRED. There's some IRAP programs. There's the Ontario Digital Media Tax Credit, and I'm going to let Jennifer talk to some of the specifics of each of these. But one of the things you got to sort of bear in mind as you're building your business and thinking about some of the underlying systems to support your business, each one of them sort of has a requirement to track what you're doing. So whether you're tracking your time around how much engineering or research and development activities you're doing or whatnot, they all sort of have it. So what you want to do as you're building out your business plan or thinking through that, you just have to make sure that you've sort of started right from the get-go, remembering that, you know, at some point, if you're going to try and apply for one of these tax credits, they're going to want to know, like, have you spent 100% of your day doing our research and development, or have you spent your day doing other things? So kind of starting to track that, and of course, doing it along the way is a lot easier than waiting till the end of the year and trying to scratch your head and go, boy, what did I do back on, you know, some date back then when I was working. So, so I'm going to just hand over the mic to Jen for a second, and she's going to talk a little bit more about some of the specifics of these programs.
Thanks, Paul. All right, so as Paul mentioned, there really is a host of different kinds of tax credits and programs that the government offers to help both startup companies and companies that are well established. Now, as a form of financing and getting cash to keep your company going, it's really important to keep in mind what the programs are, how they're administered, and how you can get the cash out so that you can keep operating. So I'm going to talk about two particular programs, being the SHRED program, and what's become very popular lately is the digital media tax credit, and it's a relatively new program. So I'm going to talk a little bit about that. So first of all, with SHRED, this is an incentive program that's administered by the Canada Revenue Agency, and the purpose of the program is really to encourage innovation within Canada. So they're looking for research and development that's being performed primarily within the borders of this country. So they're looking to fund that, and over the past number of years, the payouts have been relatively significant. There's about $3 billion that's claimed annually by the government, and that's a total of approximately just over 25,000 different companies that are claiming that. Of those 25,000 companies, about 75% of those are small companies, startup companies that are claiming small amounts as low as $20,000 and even up to $2 million a year. So significant amount of money that's being granted by the government. Something to keep in mind, SR and ED, those stand for kind of two different streams of types of research. So scientific research really relates to research that's being done in a lab. It's often being performed by universities, research institutes. Some large companies have pure research labs in their facilities that are pursuing this type of advancement in knowledge. The second part is experimental development. So that's really stuff that's being done on the shop floor. Product improvement, process improvement, the type of thing that's being trial and error and improvement in kind of enhancing our knowledge and progressing in our technological development from that perspective. Both of those kinds of development qualify for the SHRED credit. So 3 significant eligibility criteria for qualifying a project for SHRED. You have to meet all 3 of these, or your project has to meet all 3 of these in order to be able to claim the credit itself. So the first is scientific or technical advancement. So you're developing new technology, new knowledge, new science, that type of thing. So it has to be new. The second one is that you're overcoming a scientific or technical uncertainty. So there's an obstacle in your way. There's some sort of challenge that needs to be overcome in order to make this type of new discovery. And the third one is technical or scientific content. So you're following a process, like a scientific process where you have a hypothesis, you're doing some testing, some experimentation, some analysis, reaching conclusions, and perhaps you're going through that process a few times, but you're following that type of scientific process in order to reach that new technology or development. So you have to meet all 3 of those criteria for your project to qualify for the SHRED credit. As I note up here, you can claim a cash refund or a tax credit up to 45% of eligible project costs. So 45%, that's a really high amount. Now, the difference between cash refund and tax credit is that certain companies qualify to actually get the cash back. And in most cases, early stage companies that are kind of privately owned by Canadian residents, those are what we call CCPCs. Those qualify for refundable tax credits, so you get the money back, and that's really what you're kind of aiming for. Other companies that may be not entirely privately owned in Canada, or maybe public companies, they receive what's called a tax credit, which is not refundable. It goes to offset any taxes payable to the government, and it can be carried forward for 20 years to offset future taxes. But it's an important distinction to make, something to know about the structure of your company. If you need the cash back, you need to have the right structure. So I talk here on this slide, there's a couple of different examples of costs that are eligible to be claimed. You'll see that there's a focus on salaries, materials, contracts. That would include any payments or contracts that you're making to third parties to aid in your research. Looking at capital expenditures, which would include lab costs, pilot projects, test equipment, hardware, software, those types of things would be eligible as capital costs, and then overhead expenses as well. And often there's a proxy that's used for that, so you just claim a certain percentage of your total salaries as a proxy to your overhead. So, and I just want to specify the 45% is a combination of the federal and the Ontario amount. So it's a 35% federal claim and a 10% Ontario claim, which at the end of the day you're filing one tax return, so it doesn't make too much of a difference, but that is important to note. As Paul mentioned, it's really important when you're thinking about costs and salaries and wages and all that kind of stuff, it's really important to track the costs themselves and what project they relate to. Track how much time you're spending on the project. In a lot of cases, if you're a researcher, you're spending 100% of your time on the project, and that's fine. Really, anytime you're spending greater than 90%, you can claim your entire salary. But if you're a CEO of a company or a founder or one of those original people, and you're now caught up in not only doing some of the research, but now you're doing some administrative stuff, you're worrying about financing, you're getting into the other aspects of the business, marketing and development, for example, sales, those, in that case, only a portion of your salary where you're actually spending the time doing research is eligible to be claimed for SR&ED purposes. So you're really going to want to keep track of kind of how you're spending your time in order to support the actual SR&ED claim that you're making. So some examples of good documentation I wanted to give you include things like project plans, emails, meeting minutes, lab notes, timesheets, project books, if you keep like a notebook where you take a lot of notes, that type of thing. That type of documentation, which we would call kind of contemporaneous, it's happening as you go. As Paul mentioned, it's very tough to go back in time. You're filing your SR&ED claim, it's a year later, and all of a sudden now you have to make up all this documentation. That's a really tough way to do it, and it's more likely to get challenged if you're audited. So it's important to keep the documentation as you go and kind of build that into your regular working style. So I mentioned the word audit. It is possible that your claim would get audited. And I think it's just a reality you should probably be aware of. There's two different kinds of audit that can occur on a SR&ED claim. The first one is a technical audit. So they're going to come in, they're going to look at what you're doing, the project that you're doing, and make sure that they agree that it's eligible under the SR&ED program. So it's very much a focus on the engineering part of your project. The second part of the audit would be around the financial aspects. Did you claim too much of the salary or not enough of the salary? Did you claim sales and marketing expenses that don't qualify? That type of thing. So there's those two different parts of an audit, and it's pretty normal to get audited. So it's something you should consider, and if nothing else, it's a little bit of motivation to keep that documentation going. So when can you file your SR&ED claim? You would file a SR&ED claim for the expenses that you incurred in a particular year on eligible projects. So you can file that SR&ED claim with your tax return, which for a corporation would be due about 6 months after your year end. But technically you do have up to 18 months after the year end to file your SR&ED claim. If you file it after 18 months, they don't give you the money. They don't care. They don't give you an extension. There's no leniency. So just brutal truth here. Don't be late or you're going to be out of luck on the money. It's the best practice to file it with your tax return every year. And quite frankly, if you need the money, it's the best thing to do because you're going to get your cash back more quickly the earlier that you file. So it's just when you need the money, you might as well file on time. I'm going to touch on a couple of other, at the bottom here I have just a couple of Ontario programs that I wanted to mention. The OITC, the Ontario Innovation Tax Credit, is really that 10% out of that 45, so that's the Ontario SHRED program, so to speak. And the ORDTC is another 4.5% that gets added to the 10%, which is a measure that's resulting from the fact that Ontario and federal tax returns are being harmonized. So it's kind of a silly, complicated way to explain it, but there's the 10%, and then there's the 45%, and then there's another 4.5%, and they're all called something different because politicians like to make things just a little bit more complicated. I don't want you blaming the accountants for this one because it's not an accountant thing. The OBRI is called the Ontario Business Research Institute Tax Credit. This is a non-refundable tax credit, so again, you can't get cash back for it, but to the extent that you are working with a research institute like a university and you're paying them to help you with your research, you can claim up to 20% of that back on your tax return. So it's an important thing to understand that that's available. Is there any questions on the SHRED stuff? Not too much. The next one I'm going to talk about is the Ontario Interactive Digital Media Tax Credit. It's relatively new, and there's a lot of talk about it right now in the industry, and a number of companies that are just starting to kind of get through the process and starting to get their cash back. So it's become quite popular. It is a refundable tax credit again, so you're going to get cash back for this. It's a little bit different than SHRED, where with SHRED you are entitled to get that money back. If you spend money on SHRED projects, you are entitled to that money. You can claim it on your tax return. With an Ontario Digital Media Tax Credit, you need to apply for eligibility. So you need to make an application, and that has to be approved before you're eligible to claim that. So there's a slight difference in kind of the status of those programs. The expenses that are refundable are salaries and wages and marketing and distribution expenses. So a little bit different than SHRED in the way that marketing and distribution is kind of unique to this digital media tax credit. The amount of salaries you can claim is unlimited. The marketing stuff is limited to only $100,000 per product. So if you're spending that much on the product, you're limited in how much you can claim. The products that are eligible, you can get back different percentages. I've listed them up here on this slide. So 40% of eligible projects and 35% of specified products. The difference being that eligible is internally developed. So your company has done the research, developed the product, market the product, and the specified ones you've outsourced that development. So you have a third party that you're paying to do some of the research and development, and then you're doing the marketing yourself. So you get a lower percentage back on that if you're outsourcing. That's the difference there. So what is an eligible product? I've referred to it a number of different times. And in the digital media space, a product is an integrated combination of application and data files in a digital format, and they're intended to be operated together meeting these 4 separate criteria. So the first one is that they have a purpose, which is to educate, inform, or entertain an individual, present info in 2 of the following text, sound, images, intended for use by individuals, and then users can interact to choose what information is presented, what format it's presented in, that type of thing. So there's some pretty specific guidelines around that. In addition to that, they have put out a couple of different criteria that they want you to consider. It shouldn't be a product that's used for interpersonal communication, so it doesn't really have to do with individuals talking or communicating with each other. It shouldn't be developed for sale to a related party. So if you're developing it and selling it to your parent company, for example, it's not going to qualify. It needs to be developed for a third-party market. And then it shouldn't be used to promote. It's not a product that you're developing to promote another organization. It's for individuals to use. So there's some specifics around that. So the process for doing this, as I mentioned, is you need to have a product and it needs to be approved by the board. So what you can do is you can submit an application. There's an application fee associated with it, which is 0.1% of the total expenditures. So if you spend $200,000, you're going to have an application fee of $200. Once that application is approved, they give you a certificate of eligibility. Once you have the certificate, then you can go back and modify your tax returns, because you've already spent the money, you've already filed your tax returns, and so then you need to go back and amend your tax returns to get your money back. So again, the process itself is a little bit more laborious than the shred claim, but very profitable in the end. If you have products that qualify, it's quite a lot of money that you're going to get back. The process for it is going to take anywhere, if you're right on top of filing at the end of your project, you're going to get, it's going to take 5 to 8 months to get the cash back. So it takes a little bit of time to get the certificate and a little bit of time to file your returns. But if you're pretty quick about it, then about 5 to 8 months to get your cash back. Does anyone have any questions on this tax credit? It's dry stuff, eh? So the last thing I want to talk about is we talked a little bit about government financing, and it's important to be on top of it, as I mentioned, in order to get the cash back. Cash is king when you're a new company. Another source of financing that shouldn't be overlooked really relates to your customers. So your customers, you're going to bill them, you're going to collect from them, and you shouldn't underestimate the importance of that as a source of financing once you have your product ready to go and ready to market. And other important things to note about your customers. The value, especially to an early stage company, is immense. You really need to have good relationships with them and understand that they're validating your product or your service or whatever you're offering. Those customers are the ones that are giving you credibility in the market, those initial customers. So it's important to not underestimate the value of that relationship. Also, from a technical perspective, they're helping you fine-tune your product or service by giving you feedback and giving you information on what you're using and how it's meeting their needs. So it's important that you, again, have those relationships so that you have that open line of communication. So consider them partners in the early development of your business. And at the bottom here, I just want to comment that really you need to focus on cash flow. As I've mentioned, cash is really king. Don't get hung up on what numbers are showing up in your financial statement. Your revenue number can be very different than what you think it should be. The accounting rules get a little silly around that type of thing. Focus on cash. Like, get money in the door, invoice, collect, get your shred claims in. Focus on having cash in your business, because that's really the lifeblood of what's going to keep you going. Eventually the numbers will fall out, and once you're stabilized, they'll be much more important. But at the beginning, focus on cash. I think Paul's going to talk a little bit about execution.
So hopefully by now, as you've built out your business, you've got your plan, and hopefully you've also been able to see through this discussion how important it is to sort of lay out some of the major building blocks along the way, help you sort of focus your activities, make you think about your corporate structure, make you think about how you're going to finance it, think about some of these tax credits and some of the things that you want to do to make sure that as you move along, you're collecting the information to be eligible or to be able to submit those claims. Once you've sort of got all that, the next most obvious thing is it's time to execute on that plan. You've done the planning, you've got yourself set up, you've got some cash in the account, and you really got to now execute. And you know, we put this slide up, it's obvious that the next step is execution. But what's sometimes missed is how important execution is, how important it is to stay on your business plan, or if you need to move off your business plan, to update your business plan. People that are coming in, your next rounds of investors, those that are going to evaluate your business, they're going to look to see how have you executed on what you said you were going to. I mean, it's no different than any other sort of evaluation system. I said I was going to do this, I worked on it, and I've either done it or not done it. And if you've done it, that's great. You get high marks. People like you. People like your idea. People like your business and are more willing to fund it and see it continue. If you haven't done those things, you decided to watch TV instead of working, well, you're probably not going to be quite as successful. As I said, as you're going through that, I mean, your business plan can't be static. You're gonna go along and you're gonna realize that some assumption or some fact that you thought was true when you developed your business plan at the onset isn't turning out the way that you wanted. It isn't quite addressing the market that you thought. There's another market that you didn't think about before that maybe is more interested in your product now that you've moved it along. So again, it's kind of important to keep updating that business plan, keep coming back to some of the fundamental objectives that you're trying to get to, and question whether they still make sense so that you keep this sort of the ship pointed in the right direction, recognizing that sometimes the direction needs to change as the markets change, as business changes, the environment changes. And, you know, as you're doing that, especially in the situation where you've tapped your friends and family or you've got an angel investor, you've got more sophisticated investors involved in your business, you need to tell them. You need to communicate. They need to be aware of it. And there's lots of opportunity and ways to do that. They may have spots on your board. They may be your friends and family that you see at barbecues and they ask you how it's going. But really the key thing here is you've got their money. And you're sort of using it for an intended purpose. And they think that this is the purpose that you're going down. If you're switching it and there's good reason for it, they're not necessarily going to get upset about that. They're probably going to be pleased that you're thinking about the best way to use their money, but you need to tell them. And you need to communicate. You need to keep them on side, because what you don't want to have happen is those that have invested in you to sort of lose that confidence in you or to lose faith in you and to not want to continue to support your business as you continue to grow it. So again, really, really important as you're building out your strategy, think about who your stakeholders are. Make sure that you develop a mechanism to keeping them current on what's going on in the business. Just a little motivational thought though, but always bear in mind that your own resolution to succeed is more important than any one thing. So we've talked about a lot of things that might make your business successful in terms of developing a business plan, thinking about how to finance it, thinking about how to structure it, making sure you've got everything that you need to do to be eligible for some very lucrative tax credits. But sort of your own resolution to say, I'm going to do this, I'm going to stick to it, I'm going to follow my business plan is the single most important ingredient for success out of everything that we've said today. So that sort of concludes the story of starting a business. If you are excited by that and you wanted to get going or you've already started, this region has got some fantastic resources around helping early stage companies. It is just a bunch of great resources. We've listed sort of a few of the major ones. There's the Accelerator Center. Do you guys know what the Accelerator Center is? No? Okay. And I'm not, so the Accelerator Center is supported by Communitech, although they are two different organizations. The Accelerator Center is where I see a lot of very early stage, sort of maybe after coming out of university or you've got an idea and it's a bit of an application process to get in there, so not everybody's there. But the Accelerator Center for a small fee gives you some office space. There's I think there's 12 to 18 companies all in sort of the same space. There's a lot of common areas, like common meeting rooms. But there's also a lot of support. So there's mentors, there's people that have done it before. We participate in the Accelerator Center. One of the law firms in town participates in the Accelerator Center. And so think of it as both the sort of walls and the building to help support your early stage business, but also this group of advisory partners that can help on specific areas as you move along. So it is a really significant resource to early stage companies. In addition to sort of all those external resources, the other real benefit and probably what you're seeing from being part of VeloCity happens at the Accelerator Centers. Like I said, it's 18 to, I think it's 12 to 18 companies in the same location, and guess what? You're bumping into each other all the time, you're sharing ideas, and so that sort of collaboration concept really comes through. Communitech is the technology association in this area, and again, it's got a number of programs to help early stage companies. The one that's probably most relevant is called their Entrepreneurs in Residence program. And that's a program whereby, again, people that have done this, people that have run early stage companies and grown them from nothing to something and sold them, or grown them from nothing to something and have moved on to do this, they work for Communitech, and they're available to sort of work with you and help you think through your business plan, think through some execution issues, and again, do it within the context of having been there before. So a really important resource. Tech Capital Partners, you heard Jackie, the speaker, if you were in her session this morning, they've got just a wealth of information in terms of seeing what's out there, being able to talk to you about things to think about when you're financing your plan, and of course there's guys like us that are also available to help in that respect. So that concludes the end of our formal presentation. Hopefully, we did. We left a few minutes for questions. So I'm going to stop talking and open up to you guys, and we can cover anything that Jennifer and I covered in this presentation, or if there's any other topic that you'd be interested in chatting about, we may be able to speak to it as well. All right, well, that's what happens when you present after lunch, right? Here's, oh God. And it's Saturday after Friday. I'm surprised I'm still standing, actually. It was poker night last night. So.
Well, even though these guys don't have any questions, they may afterwards, so that's great that you provide your contact information.
Yep.
I know that Kate's mentioned to us about, don't you guys do something at the Accelerator Center? You have office hours there as well, which has been helpful for some of our students in the past, so kind of as they get going. I think just all the information you guys provided today was really helpful, great knowledge, and we just appreciate you taking time out of your Saturday afternoon to come in and share all that with us. So
it's our pleasure.
VeloCity, thanks so much for coming in. That's for you.
Great, thank you.
And Jennifer. Thanks, guys.
Thank you.
And just so you guys know, there's Timbits and coffee out there if you want to wake up or warm up. I know this room is like freezing. And then we have our closing session in about 15 minutes. So
great.
If you guys want to stick around, feel free. Otherwise, thanks so much for coming in.
Thank you. Thanks, everyone.